If you're like most small business owners, you rely on expert advice from your CPA and other professionals. But your CPA can't be with you every time you have a conversation with a potential business partner, investor, or lender. This video will help you better understand the 7 key metrics and financial ratios that are included with eCredable Business Lift Plus, and how to use them to your advantage. We refer to these metrics as business insights. These metrics are accessible when you select Business Insights in the left navigation for eCredable Business Lift Plus. The third annual Citizens Business Outlook report sourced data and interviews from hundreds of small and mid-sized businesses to reveal that insight-driven companies, the ones that tap into expert advice at least weekly, expect to outpace other companies in 2024. 87% of these companies expect fast expansion in 2024. 72% have growth-focused 5-year plans. And twice as many insight-driven companies had double-digit growth in 2023. And 2/3 of insight-driven companies expect to grow by 10% or more in 2024. And finally, almost 4 in 5 insight-driven companies report having an extremely or very good understanding of company cash flow. This might seem like a no-brainer, but we can't understate the importance of managing your cash flow. So, what exactly are business insights? Well, it could mean a lot of things, but the business insights included with eCredable Business Lift Plus are key metrics and financial ratios to help you better understand and manage your business. In addition to cash flow, these business insights include gross profit margin, net profit margin, number of full-time equivalents or FTEs, rent expense ratio, payroll expense ratio, interest expense ratio, debt to asset ratio. There are many other financial ratios that your CPA or banker might be concerned about, but these metrics and ratios are the basic ones you should start with. This framework provides a simple approach to knowing how often you should pay attention to these metrics and ratios. Let's get started by looking at cash flow. Cash flow is the most important financial measure for most companies. Cash flow is the foundation that all other financial ratios depend upon. Cash flow is essentially the calculation of how much money you take in less how much money goes out. It goes without saying that you need to take in more than you spend. Your online banking app will help you understand cash flow. Your CPA will help you understand your cash flow as it relates to your P&L statement. The reason why the cash flow generated from eCredable Business Lift Plus relies on your accounting package is to capture the inflows and outflows across all financial relationships, not just one bank account where you make and receive payments. It's very common for e-commerce businesses to use payment methods like Stripe or PayPal, which will not be reflected the same in your bank cash flow analysis. The calculation is as simple as subtracting your total cash outflows from your total cash inflows. In this example, the inflows for the reporting period are $1 million and the outflows are $900,000, resulting in a positive cash flow of $100,000 for the period you are analyzing. Now let's take a look at gross profit margin. Gross profit margin is a crucial metric that can significantly impact different business models in various ways. Pause the video to read more about your business model before continuing. Gross profit margin is calculated by dividing the revenue into the sum of the revenue minus the cost of goods sold. In this example, a company with revenue of $50,000 and cost of goods sold of $20,000 has a gross profit margin of 60%. Gross profit margins vary significantly based on the type of business you are operating. Pause the video to read more about your business model. Net profit margin shows how much profit remains after all expenses, including taxes and interest, are deducted from total revenue. Pause the video to read more about your business model before continuing. Net profit margin is calculated by dividing the revenue into the sum of the revenue minus the cost of goods sold, plus expenses, plus interest, plus taxes. In this example, a company with revenue of $45,000 and other costs that total $38,500 has a net profit margin of 14.4%. Net profit margins vary significantly based on the type of business you are operating. Generally, a good net profit margin is around 10% for most businesses. Higher percentages are great but rare. Pause the video to read more about your business model before continuing. FTE, or full-time equivalent, is a commonly used term with HR professionals. It allows companies to allocate people resources and measure these resources consistently across different parts of the company. Knowing how many people are used in the operation of the business is a key metric that can be measured month over month, quarter over quarter, and year over year. Many companies use this metric to understand how they compare against their peers. For example, it's very common in the software industry to compare the revenue per FTE when benchmarking yourself against another company. The monthly measurement method is used by various government agencies when setting policies regarding benefits. Most non-government organizations rely on the more typical measure of 40 hours per week. In this example, the company has 8 employees who work a typical 40-hour work week. They also have 4 employees who job share and work 20 hours per week. Based on a 4-work-week month, this company has the equivalent of 10 full-time employees. eCredable Business Insights helps you compare this ratio against the companies in your peer group to see how you stack up. Managing the real estate required to run a business is important for any business, but critical for larger businesses that need a lot of real estate. Using this ratio to know when to consider making changes is very helpful. If your company is spending twice as much on rent as your peers, you probably need to take a closer look at this expense. The rent expense ratio is a simple calculation where the rent expense is divided by the revenue. In this example, the company has revenue of $2 million and rent expense of $50,000. The result is a rent expense ratio of 2.5%. eCredable Business Insights helps you compare this ratio against the companies in your peer group to see how you stack up. This is a key financial metric used to understand how much money you are spending on paying your employees. For companies that require a lot of people to produce their product or service, this is usually one of the largest line items in the P&L statement. Tracking month over month provides valuable insight into whether adjustments need to be made to the number of employees or how much you are paying them. The payroll expense ratio is a simple calculation where the payroll expense is divided by the revenue. In this example, the company has revenue of $2 million and payroll expense of $450,000. The result is a payroll expense ratio of 22.5%. Use eCredable Business Insights to compare this ratio against the companies in your peer group to see how you stack up. The interest expense ratio measures how much of a company's revenue goes towards paying interest on its debt. This ratio is sometimes referred to as the interest coverage ratio. A high ratio could signal that a company is heavily burdened by debt, which might limit its financial flexibility. Keeping this ratio in check helps ensure debt is managed effectively and doesn't stifle growth. The interest expense ratio is a simple calculation where the total interest expense is divided by your revenue. In this example, the company has interest expenses totaling $40,000. Their total revenue is $2 million. The result is an interest expense ratio of 2%. Use Business Insights to compare this ratio against the companies in your peer group to see how you stack up. Interest expense ratios vary significantly based on the type of business you are operating. Generally, a ratio below 5% is common for most businesses. Pause the video to read more about your business model before continuing. Slide 38. This ratio measures the proportion of a company's assets that are financed by debt. A ratio above 1 or greater than 100% means the company has more debt than assets, which could be a red flag for financial stability. Conversely, a lower ratio suggests better financial health and a more conservative use of debt. The debt-to-asset ratio is calculated by dividing the total assets into the total debt. In this example, a company with debt of $75,000 and assets of $250,000 has a debt-to-asset ratio of 30%. Use Business Insights to compare this ratio against the companies in your peer group to see how you stack up. Debt-to-asset ratios vary significantly based on the type of business you are operating. Generally, a good debt-to-asset ratio is around 50% for most businesses. Pause the video to read more about your business model before continuing. Slide 43. We covered a lot in this video. Feel free to rewind the video to the metric or ratio you want to review again. If you're not already using eCredable Business Insights, log into Business Lift Plus and link your accounting package today. You can immediately start realizing the benefits provided by eCredable Business Insights. Not only will eCredable Business Insights help you manage your business better, but you'll also be prepared when it comes time to secure additional capital to grow your business. eCredable, helping small business owners at every stage of the life of their business.